Welcome back to Talk Nerdy to Me, a financial guide for entrepreneurs, where we dive deep into the financial issues that small to mid-sized businesses and high-growth companies face. And then we'll explore practical solutions to overcome them. I'm Michelle Delker, founder and CEO of the William Stanley CFO Group.
And I'm Robin Keithley, VP of Operations here at the William Stanley CFO Group.
So glad you're here. She is the peanut butter to my jelly. She really makes all the magic happen. And a couple of weeks ago, we interviewed, was it David Mastrorio with DFCU? He's the Chief Lending Officer. And we really wanted to help our partners, our small to mid-sized businesses, understand what the gold standard looked like as it related to treasury partners. And one of the things that he did in his intro was he shared how he found his way into banking and why entrepreneurs were so special to him. And I realized, as I was obsessively thinking late at night when I should be sleeping, that we had not really shared sort of the story of how our business came to be. So I thought maybe we could take a couple minutes and do that.
Sure.
Oh, yay. All right. So I'm Michelle Delker, the founder, and I worked in the corporate world for about 20 years. I'm an accountant by trade, super nerdy, very much a talk nerdy to me kind of girl. And I got all of my education, undergraduate, graduate in accounting, and then also got a CPA license along the way. And for the first decade of my career, I worked with large publicly traded organizations, usually Fortune 100, which was a great experience. But about a decade in, I transitioned out of those big companies to working with more of an entrepreneurial organization. There were about 35 million when I joined, about 100 million today. And it was there that I fell in love with entrepreneurs. We had a visionary leader who practically levitated when he walked. He was just so charismatic and believed so passionately in what he did. And it was like a drug. I just couldn't get enough of it. But during that time, one of my family members became ill, and I decided, hey, I'd like to transition into a slightly different sector of healthcare. And that was skilled nursing, which was an incredible experience. During my time there, I had an opportunity to transition into the CFO seat. And I remember visiting my dad in Louisiana. He had Parkinson's disease, and he was pretty deep into I don't know how to describe it, but he was progressing pretty rapidly and winding down. And it was the most incredible conversation I had with him. My dad was a second-generation Italian. He was born in New Jersey in the 1940s, and he was programmed to provide, and he was also an entrepreneur. And because he was so good at what he did, we didn't get to see him very much. And on this fateful trip to Louisiana, where I was sitting and talking to him, he looked at me and he said, hey, I'm so proud of you, so proud of all of your success, your professional success. But I want you to know that I did it wrong. I worked too much. I didn't spend enough time with you and your brothers. I'm sorry. This life is about the relationships. Always focus on the relationships. And in that moment, you've met my dad, right?
I have met him.
Not a lot of words. He doesn't share the deep thoughts and feelings very often. But he completely pulled back the curtain for me. And I understood entrepreneurs in a way that I never had before. I realized in that moment that a lot of entrepreneurs feel like they often have to choose between professional success and personal fulfillment. And I didn't think that that was a choice that had to be made. And so really that led to the founding of the business. That conversation was a couple of years ago. And then shortly after my dad passed, I made the decision I was going to leave the corporate world and establish this company to help small to mid-sized businesses who didn't have an appetite for that permanent full-time CFO. And in reality, I mean, we're really working with a lot of folks that are visionary leaders, like the gentleman I described. And we wanted to start this podcast to be able to provide additional access to resources and then also insights and, anecdotal things, because this can sometimes be a topic that is uncomfortable for a lot of people. Do you know? You start hearing really technical terms, people become uncomfortable and maybe tune out of the conversation. But our goal here in Talk Nerdy to Me, aptly named, is really to make it more accessible and to address the challenges that so many folks, so many entrepreneurs that are small to mid-sized face, and then to provide some potential remedies. So I felt like, I think this is episode 6.
Oh my goodness.
Right? We've done so much. We've shared, I think, some really great content. We've had some wonderful people on, but had not really shared that story. So thank you for allowing me to have that soliloquy. That's who we are and what we do. And I guess I left out the William Stanley CFO group. My dad is the William, and then the Stanley is my father-in-law. The business is named after their legacy of hard work and family. And here we are.
Here we are. Well, thank you for sharing that with us. So today we're tackling a really important topic that most business owners, especially small business owners, don't fully understand. Why EBITDA, net income, and cash flow are completely different things. It's a misconception that can lead to serious trouble if you're not careful.
Stop it. You are not serious.
I'm serious.
Different things. True story. So another story, but this one not about my dad. We've worked with a lot of incredible companies over the years, and we've worked with some smaller companies, $10 million organizations, and then larger, $500 million in annual revenue. And more recently, we were working with a $200 million company, and we're going to call them Client. Client had no cash, despite being what many would consider a successful business. It had less than a 1% net margin, an extended cash conversion cycle, and it was constantly overdrawn on its line of credit. And I think this is a prime example of how high revenue doesn't necessarily guarantee financial stability.
It's fascinating because most people hear $200 million in revenue and just assume the company is swimming in cash.
Like, how are they swimming? Is it the breaststroke? Is it the backstroke? I hear you. A lot of people are really fixated on that top line revenue. But when you dig into the financials, you really get the full picture when you look at those particular metrics. And when we dug into these financials, it was clear that there was something else that was happening below the surface. So today, we're going to take you through a step-by-step breakdown, starting with EBITDA and then moving to net income and finally, dun, 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 to cash flow. And along the way, we'll show you why each of these numbers matter and why they're not the same. Is it me again?
It is.
So let's start with EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And this is often touted as a measure of a company's operational performance because it strips away a lot of the non-operational costs. But it's not the full story.
Yes, EBITDA shows how much money a company is making from its core operations, but it doesn't account for real-world experiences like interest and taxes. Right?
Right. And more. So let's go back to this client, the $200 million company. Their EBITDA looked pretty healthy at first glance. It was about $6 million, not like rupees, not pesos, $6 million US dollars, which sounds impressive.
$6 million sounds solid, but that's not the full picture.
It's not. It's like half of the picture. The other half's been folded over. Because after paying interest on their debt, that $6 million shrunk to $3.5 million. And then after paying taxes, which was about $500,000, they were down to $3 million. And then depreciation and amortization was another $2 million. So when you take all of those out, we were left with just $1 million of net income for a $200 million organization.
That's a huge difference. You've gone from $6 million in EBITDA to $1 million in net income, a massive drop once all real-world expenses are considered.
Did you just do public math? 6 minus 5.
Always.
And even the net income doesn't tell the full story. We really need to look at cash flow. Cash flow, that's how we pay our bills. That's how we pay our employees. Cold, hard cash. So let's understand it.
So you've got $1 million in net income, but what happens next? How does that translate to the cash flow?
I mean, it gets tricky.
Tricky.
Run DMC, for those of you who don't know, it's trick to rock a rhyme. It does get tricky because the company that we're talking about operates on an accrual basis, meaning that it recognizes revenue when it's technically earned and it recognizes expenses when they're incurred, not when the cash changes hands. So that doesn't tell us when the cash is going to move. So we have to add back non-cash expenses, right? Like depreciation and amortization. And then we have to factor in other things like capital expenditures and changes in working capital. So capital expenditures, we're buying a building. We may be able to depreciate that building over an extended period of time, but the cash
money is gone.
Gone, baby, gone. The cash is going. And in this particular case, outside of what I would consider to be a pretty thin margin, this client's cash conversion cycle was lengthy and it further extended over the years, which made a really big difference for them from a cash management perspective.
That's a crucial point. There's a big difference between profits on paper and cash in the bank.
Word. Despite positive net income, these guys were overdrawn on their line of credit due to slow collections and longer payment terms. Their cash ultimately was to the good by about $550,000 for the year. So their ending cash balance was $550,000 higher than their starting cash balance. But you'll see when we get to their balance sheet that is a really thin cash balance for a company with such high expenses. I want to say they're running like 2 days cash on hand and totally maxed out on their line of credit. So, I mean, even if you're in good health, that's when you start to like palpitate a little bit, bring out the defibrillator.
Yes, this example highlights the challenge so many companies face. This client was in a constant cycle of borrowing, juggling payments, and scrambling every month to stay afloat.
Just to stay afloat, all that work, right? And while their EBITDA and net income appeared positive, their cash flow was just a struggle in general. And they spent so much time trying to manage that I think they missed some opportunities from a strategic perspective. But it's not all lost, right? If there's something we could do to optimize these areas, the potential for improvement is significant.
So let's talk about what could have been done differently. What are the key areas for improvement?
Well, do you remember in a prior episode, we talked about a financial diagnostic, right? Like we've got the income statement, which everybody knows and loves, the P&L, not P&L, but P&L, profit and loss. And then the balance sheet. So the balance sheet was what? It's your cumulative GPA, like your whole high school career, or your P&L is like your 9-week report card. So we need to look at both of those. And when we, yes, can we? All right. So let's pull up a different document and take a look at that. So we're going to look at their trending income statement. Here what we've got is their income statement over a 6-year period of time from 2019 through 2024, which most people would consider to be excessive, but we want to take into consideration the impact of COVID because we know that not everyone has resumed pre-COVID performance. So that gives us a good baseline of what we looked like before there was that disruption. And then helps us compare to where we are today. And I don't know. I mean, I see there was significant disruption from 2019 to 2020. We were previously operating at about $215 million of revenue. And the very next year, $186 million.
It's almost like people stopped needing whatever's being provided here. Or they couldn't afford what was being provided here anymore.
There's so much that happened. And then in the subsequent years, it looks like we've been working so diligently to try to rebuild that top line. But we're still, all these years later, sitting at 200 million. So we've not fully recovered there. And then when we look at the expenses, the operating expenses, when we were, generating 215 million of revenue, our operating expenses were close to 118 million. And when we look at 2024, it does look like those have come down considerably. So that looks helpful. But when we drop to the bottom, to the net margin, our net margin used to be 4%. Mm-hmm. So real talk, that means for every dollar of revenue that we were generating, we were keeping 4 pennies. And what we're seeing in 2024 is for every dollar of revenue that we're generating, we're keeping a half of a penny.
Yeah, that cost of goods sold line has really grown as well. I wonder if that has something to do with supply chain, and isn't everything more expensive now?
Chica, you're so smart. So, looking at this is helpful. There are some things that absolutely leap off the page, but because it's the dollars and there's such volatility with performance, I'd also like to look at it from a vertical income statement perspective. Is that okay?
Yeah.
She said yes. So the vertical income statement is where we take our expenses and we express them as a percentage of our revenue. So for every dollar of revenue, this expense is X pennies. And so when we've got significant volatility, if we're going up, there's an opportunity to manage that cost structure down and pick up additional margin. But when that top line is going down, we need to make sure that we're diligent about flexing that cost structure to ensure that we're preserving. And considering that we've gone from 4% to 0.5%, we've definitely got some significant erosion. And when we look at the vertical income statement, it shows us the targeted areas where we've experienced some pain, as it were. So, I mean, you mentioned the gross profit. Cost of goods sold went from, what is that, 38%?
To 45. Ouch.
Gosh, that's a lot. That's a lot of percent. So, I mean, just from a gross perspective, we're losing a considerable amount. And then when we drop down to operating expenses, what do you see there?
It looks like we're doing better than pre-pandemic in the operating expenses. So we're paying attention to our payroll and all that, all the items that go into that category.
It's really interesting to me because we were sitting at about 55% in 2019 for operating expenses. Today we're at 52%. But what stands out to me is in 2020, when revenue dropped significantly, we made some really...
we made some tough decisions to get those costs down.
And they were down to 47%. But then they've steadily grown back up. So it feels like there might be opportunity there as well. Mm-hmm. And then, as we said, there are non-operating expenses that we still have to contemplate, right? So we do borrow money. We have to pay interest on that. And did you notice anything about interest rates going up?
I mean, I think it's a thing.
The cost of money, it's more expensive, right? So even though the amount that we're borrowing is pretty close to what we borrowed previously, the cost of it is more significant. And look at that. We're still paying taxes. Good for us.
Yay.
All right.
Everybody loves taxes.
So I think trending is super helpful, but also, I mean, looking at the comps is really what's going to anchor us into normalcy for that particular sector. So we like to go out and pull publicly traded comps because a lot of times your neighbor who's operating in the same business as you doesn't open their books and say, here's what I'm doing. Wouldn't that be nice, right? So we've got two different comps that we're comparing, and we can see how they responded to the pandemic and then how they've recovered. Should we go back on script now?
Sure. We weren't on script before.
I mean, this was unscripted review of clients' trending income statement, dollars and percentages.
I feel like we got it.
We did so good. So for the client, we identified significant opportunities for improvement. There's definitely something sitting in there in that cost of goods sold line that's extraneous. I mean, we can see that from their trending performance, and it's even more highlighted when we look at the comparisons. Comp 1, their gross margin is 58%. Comp 2's gross margin is 60%, and ours is sitting at 55%. So it looks like it can be done. It can be done, and it can be done better. And then even though our operating expenses have gone down compared to what they were pre-COVID, they're high compared to the competitors. They're sitting at 52%, but Comp 1 and Comp 2 are both below 50%. And then, I mean, we'll also have to look at the balance sheet metrics, but the conversion cycle, when we look at that conversion cycle for us, we're floating significantly more days. Comp 1 and Comp 2 are floating less. And I mean, also they're offsetting their AP with their AR, so they're really just floating inventory.
I feel like that's something we've talked about before too.
Stop it.
So let's pause here just for a minute. One of the most striking differences to me is in their cash conversion cycle. We mentioned earlier that the client's DSO has stretched to 56 days, which is a stark contrast to Comp 1 at only 25 days and Comp 2 at 47 days. And it's significantly higher than when we started. It used to be only 40 days. It's degraded significantly.
So if we look at the balance sheet here and how it's trending over a period of time and then the corresponding metrics, that's exactly what we'll see. It used to be 40 days of sales outstanding, and now it's 56 days. Previously, our payables were about 50, and now they're at 40. So we are floating significantly more. So what could be driving this? I mean, so many different things, right? It could be their collection practices. So to me, I mean, there are so many automations that are available today that can help make invoicing and collections more efficient. You can send customer invoices from an automated system. You can send reminders, follow-up, all of that, versus having a team, like maybe a collections team, And I know that our client was still leveraging those outdated processes, which 100% is going to cause a delay if the collections aren't that team's full focus, which they weren't. And that in turn puts pressure on the working capital or their liquidity, their cash.
Yes, that's where the cash flow squeeze comes in. When you're waiting nearly 2 months to get paid, it's no wonder that you're constantly overdrawn on their line of credit. Comp 1 and Comp 2, meanwhile, have their cash cycles tightly managed, which frees up liquidity for growth opportunities.
And even between those comps, 1 and 2, we see a divergence in DSO, right? Like one is collecting more expeditiously than the other. So clearly, like customer type is different. But what they are doing the same is negotiating commensurate accounts payable terms. So their AR and their AP is almost perfectly offsetting. And it's just that inventory that they're floating.
I'll say it again. It feels like there's a lot of opportunity for improvement here.
You know there is. I agree. So let's dig a little bit deeper into the comp trending to better understand why their performance diverges so sharply from their competitors.
I thought you'd never ask.
Oh,
just kidding.
She knew I was going to
always ask. When we analyze clients' financials compared to Comp 1 and Comp 2, some interesting patterns emerge. Like look at the gross margin fluctuation. The comps dipped during COVID, but they recovered much more quickly. They found their footing and have managed to achieve much higher margins of 57.5% and 59.5%, respectively, in the recent years.
And we were at 55%, right? I mean, it's huge, especially when you consider we're talking about $200 million. It looks like our client's cost of goods sold has been much higher. And I think there's likely an opportunity to more efficiently manage those supplier contracts. We need stronger relationships. We need better pricing, and we need automated processes because that collections team with the, dialing and the calls is not the only antiquated practice that's currently being employed here. And that's compressing our margin. It's popping up our cost of goods sold, and that margin is shrinking.
That's a great point. When client renegotiates contracts, particularly with suppliers and service providers, they could see an immediate impact on their gross margins. But but where's the talk about their product mix? It looks to me like our comps might have some higher margin services or products, while our client is still heavily reliant on low margin offerings, which eats away at their profits.
I think that's a really astute observation. I mean, product mix is a really big deal, even when you're talking about folks that are similarly positioned to you. The product mix isn't going to be exactly the same. And for anyone, really understanding profitability by product and customer is critically important because at the end of the day, each relationship should be contributing to the bottom line in a positive way.
And let's not forget about their operating expenses. The SG&A expenses have consistently been above 50% of revenue, while Comp 1 and Comp 2 are much more disciplined, keeping their cost below 50%. We saw that Comp 1 specifically has focused on cost-saving initiatives like leveraging automation and outsourcing to streamline processes.
I think there's so much opportunity. I mean, really, because we can see in 2020, they were able to flex that muscle and contain those costs, and then just lost that as the business started to come back. So based on what we're seeing, what would you propose that this client does to improve their business?
Well, I think it's pretty clear. It's all right here. From an income statement perspective, there are definite opportunities to restructure pricing.
What do you mean?
We need to perform a thorough customer profitability analysis to understand where the repricing is warranted. Maybe we need to reevaluate some of the products we are offering. It is also clear that we're overpaying for our cost of goods sold. We need to renegotiate pricing there as well. If we are promising the vendors X number of dollars of business, we need a discount. It's obvious that our competitors are getting that. And let's talk about that SG&A. We saw from their trending that they were able to make meaningful cuts to expenses during COVID, but they've ramped back up over the last couple of years. There's significant opportunity to make more thoughtful there.
Chica, calm down. This is her very excited. Very excited. You're right. I see it. It's all right here and begging for help. And beyond improving profitability, there's also opportunity to improve cash management, optimizing the conversion cycle, pushing customers to pay promptly, renegotiating vendor terms to extend payables to market terms so AP and AR offset, and then hanging on to the extra cash that we generate through improved operations. I noticed in the first year that the company made a notable amount of money before COVID, and then half of the earnings were distributed to ownership, which left the company in a very thinly capitalized position, which is one of the reasons why it so heavily leverages debt. But this time, we need to keep cash from the improved performance in the company, maybe pay down some of that debt and reduce our interest expense, and ultimately fortify our capital position.
Preach.
Preach!
All right, so now we're clear on what needs to be done, but once we do them, what will the client's financials look like?
Hold on to your hat, Chica. This is great. So with optimization, do you see this? Their EBITDA increases from $6 million to $22 million, and their net income increases from $1 million to almost $11 million.
Hold on to my hat, clutch my pearls.
She's a Southern girl. So this would result in positive cash flow and significantly improved performance, right?
That's a massive transformation and really demonstrates how targeted adjustments can lead to substantial gains across the board, from EBITDA to net income to cash flow.
Right. And so regarding the cash flow, implementing those optimized automated tools, we're compressing the cycle. And so the turnover is more frequent. The velocity of cash improves. Word, she says. And so if you'll remember, this whole conversation started because so many folks originally thought big revenues, no worries. The details related to the massive transformation, wouldn't that be nice to know, right? So we did a deep dive, a profitability analysis, and we saw that we were behind as it related to pricing. We needed to effectuate a 3% price increase. We also went to bat and negotiated with our vendors as it related to our cost of goods sold, and we were able to garner a 2.5% vendor discount by committing to a certain spend, right? And an exclusivity, which was great. We looked at some of our bigger operating expenses. We had some insurance policies that had renewed at high levels. We were able to make some changes with our risk partner and our corresponding policies, and we picked up a $2 million improvement there. That's incredible. We had also learned that we didn't need to travel the way that we did pre-COVID. We learned that during COVID. We changed our travel policy, $1 million. Professional fees, we had grown to a size where it didn't make sense to outsource certain things. And maybe we brought a GC in instead of paying an external party. That was another $1 million. And then we also strategically aligned our executive team incentive compensation. Instead of just paying guaranteed bonuses, we tied it to the performance of the company. So top line 3% increase in pricing, 2.5% vendor discount, and $5 million of underlying changes. That brought us from $6 million in EBITDA to $22 million, or $550 in cash flows to $7.5 million. That is super meaningful.
Snaps.
All right. And if you'll remember, this whole conversation started because so many folks originally thought big revenues, no worries. But we've demonstrated that sometimes that's just not the case.
Right. And I think it's important to shine a spotlight on another one of our clients, a much smaller client. And their case study demonstrates that revenue size does not necessarily dictate financial success.
I love these guys because it's such a great story. $10 million in annualized revenue, right?
You got it, $10 million. But look at that. More than $4 million in EBITDA, more than $2 million in net income, and more than $2 million in cash flow. This tiny $2 million company has 4 times the cash flow of the original case study, the $200 million company.
I think that's where people's minds are blown. This $10 million company is more profitable than the $200 million company was. And that inclination is to think that those higher revenue companies are swimming in cash. Here we've got this much smaller company absolutely knocking it out of the park in every single area. And we've said a lot, so I think it's probably now time to wrap it on up.
Sounds good. Before we wrap up, I think it's important for business owners to take away that even if you're generating significant revenue, poor operational efficiency and cash management can prevent you from being financially stable.
And these trends don't change overnight, but by focusing on key areas for improvement, you can see measurable progress.
We'd love to hear from you. What challenges have you faced when managing cash flow in your business? Do you have questions or comments about anything we discussed today? Feel free to reach out to us. We're always happy to help.
Yes, you can connect with us directly at the WilliamStanleyCFOgroup.com. And please don't forget to tune in next time for another deep dive into the financial challenges that small to mid-sized business owners face. We've got more exciting topics coming your way.
Thanks again for joining us on Talk Nerdy to Me, an entrepreneur's financial guide. Until next time,
Okay.
bye.